This week we're going to look at emerging markets and the recent outperformance of emerging markets relative to global developed equities. In the chart here I'm looking at emerging markets in local currency terms as a ratio to global equity markets. Since December, EM has outperformed by about 9%. Since February, the trough in markets, EM is up around about 21% versus 11% for the global developed markets. So I just want to go through and explore some of the other factors that may be behind this outperformance. The first one I want to have a look at is just looking at relative growth between the two regions. And in this one, I'm looking at emerging market industrial production growth versus advanced economy IP growth. So that's now the red line on the right-hand scale. So this is a much more volatile series. In fact, why don't we just smooth it? And broadly, it's picked up the swings in relative performance, although, as I said, a much more volatile series. Since the GFC, the premium or the excess growth achieved by emerging markets has dropped from around about 14% back to as low as 1.5% in 2010, and has certainly stayed in quite a low range since 2009, 2010. What's happened more recently is started to see a slight improvement in the excess growth. This is in the manufacturing sector in emerging markets. So that may be one factor. If we look more broadly at a measure of GDP, relative GDP, and this is from the IMF, the red line now shows emerging market GDP relative to advanced economy GDP growth rates. Got as high as 6.5% just prior to the peak in the market, having picked up from basically in line in 1988, 98, 99. And ever since 2009 has basically been on a one-way move, reaching the low of about 2% in 2014. Now, it has since stabilised. In fact, the most recent observation there is as a projection, but certainly this could be something that emerging markets are finding slightly more favourable at the moment, off a very low base, mind you, particularly when it comes to countries such as Brazil and Russia. What else might be at play? Well, as you might expect, commodities traditionally have played a large role in emerging markets, although that has shrunk over time. Certainly with declining commodity prices, it has. If we put up the CRB, just the spot price index, you can see they're quite close relationship, and more recently the pickup in the CRB around about the same time that emerging markets started to outperform. So, there's been a commodity price stabilisation and even a pickup, but there's been several false alarms along the way, or false signals along the way. As you can see here, back in 2013, we had a brief period of rising commodity prices only to be disappointed. So could this be another one of those periods? Now I want to turn our attention to the US dollar, and there is an inverse relationship. I'm looking at local currency emerging markets compared to global developed markets, and then on the right-hand scale we've got the US dollar against the major currencies. So you can see the relationship there. What I'll do is just look at the sort of a rolling correlation of the two. And if we look at this chart, we can see this is a rolling 40-month correlation. We can change that. Actually, I'll look at rolling 36 months. You can see there the very strong negative correlation between whatever the US dollar is doing and the relative performance of EM. So EM outperforming, US dollar actually sideways to maybe slightly softer over the 6 months, but nevertheless that does present what you would expect to be a risk. One of the risks to emerging markets in the current environment is that the US dollar once again begins to rise. And what sort of scenario could we see that unfolding? Well, it would generally be a more aggressive tightening by the Fed than the market currently anticipates, but nevertheless that is a risk. What are some of the other factors that we look at? We generate some indicators for earnings for emerging markets compared to the rest of the global regions. We also do that for valuations, monetary conditions, macro conditions, and generate a composite index. So I'll go through those one by one. The valuation indicator, so this is looking at forward PE, PE-REL, its own history, PE-REL markets, um, uh, dividend yield, and a number of other measures, and they're combined to produce an overall valuation signal. So for emerging markets, on the right-hand scale, basically we have 5 regions. So we're looking at the US, Europe, ex-UK, UK, Japan. We also put in there Australia. So what you can see here is that it's got a fairly high ranking, up around about 0.8. The ranking goes from 0 to 1, so quite a high valuation ranking. So that's in favour of emerging markets, although it's since deteriorated a little bit. What about the EPS signal? The EPS signal is looking at earnings revisions, earnings growth rates, and that has actually improved over recent months. So that's up towards a 0.7 reading after being quite a low reading during the whole period of 2010 to 2015, coinciding with underperforming emerging markets. What about monetary conditions? Well, this is perhaps a negative. Monetary conditions certainly not as easy in the emerging markets as they are in the developed markets. The macro indicators, well, macro indicators actually picked up in the US, to some degree in Europe, although we haven't seen much of a pickup in emerging markets. So that's probably a fairly neutral indicator at the moment. So the key sort of fundamental drivers for emerging markets at the moment, valuations are relatively attractive, and earnings have some sort of momentum on top of those other macro factors. US dollar going sideways is also being a support for emerging markets.